Is buying a home the ultimate financial achievement to get on that wealth elevator or escalator that people have been talking about? Or could it be that financial trap that slows you down? Is buying a house to live in a good financial decision for me? Uncover why investing in real estate might be better for you than just buying your own primary residence right off the bat. What's up? My name is Lane Kawaoka. I am the author of The Wealth Elevator. I started as an engineer. I graduated college back in 2007, started working for the man and discovered I didn't like it. But by that time, I had started to build a real estate portfolio. My first property was in 2009, and then I bought a duplex in 2012. Eventually, I bought 11 of these single family home turnkey rental properties. Later on, we started an investment company and we now own over $2 billion of assets, 10,000 units plus. I wanted to break down and start at the beginning, right? Because I think that's what this channel is for, to help folks like yourself cut through all the get out of debt, be really frugal type of information out there. And there's a lot of more advanced information out there that we also have on this channel too for people over $2 to $3 million net worth. But speaking to the person out there who is getting started, you might be in your 20s, heck, you might even be in your 40s, right? This applies to people who are under $250,000 net worth. You're basically getting going, right? You might be out of debt, but you're just starting out in your financial journey. And in the Wealth Elevator book, we call this in the first floor of the Wealth Elevator. Eventually, you'll buy some syndication deals, but for now, we're trying to get you off the ground and buying rental properties. And the big question is, with very limited funds, do I buy a primary residence and make my spouse happy and not get divorced? Or do I go and buy rental properties and start to build my wealth? Logically, it makes sense, right? When you're making money in this rental property, you're making money four ways: mortgage pay down, which your tenant is doing instead of you; the tax benefits, which we also have another section on this channel on taxes and exactly how the wealthy lower their taxes. Third, you're going to get the cash flow from the investment, and then the appreciation, which you have good leverage and you're going to get that in the long term. But here's how I would break it down. There's generally two camps here. The first camp, I think, is the majority of people out there. If you live in areas such as California, Washington, Hawaii, where you are in a very high-priced area, we talk a lot about rent-to-value ratios. Real quickly, a rent-to-value ratio, you take the monthly rental price divided by the purchase price of the property. If you're in an area where you're buying properties where the rent-to-value ratio is less than 1%, generally you fall in this sort of paradigm that I'm talking about here. For example, buying a primary residence in California, maybe you're lucky to find a place that's $400,000 purchase price that will rent for $2,000 a month. That's $2,000 divided by $400,000, and that is 0.5%. So that is no bueno. That's not going to work. Therefore, you're in this paradigm of locations where you should probably go ahead and forego buying that primary residence and take that money elsewhere, ideally out of state, to a much better economic climate, politically better for the landlord. I don't want to say anything politically, but the red states are typically better to be a landlord than the blue states out there. So here's the game plan, right? If you live in these types of locations, California, Hawaii, New York, Boston, Miami, etc., simply places with less than 1% rent to value, you're going to want to probably take your $20, $30, $40, $50,000 and go and buy rental properties at that point. Now, if you're already an accredited investor making $200,000 a year at your day job, or already have $1 million net worth saved, as most of our clients do who are already in their 40s and 50s, you probably want to skip over rental property ownership and go right into syndications and private placements as a passive investor. If you want to check out that book, we have a little tear out sheet. I'll put it up on the screen where you can see where you fit in terms of net worth and what investment strategies you should do. But just speaking specifically to buying your primary residence, probably better to forego buying that primary residence here because you are just in a too high priced area, and this is going to dampen your ability to put your money to growing more and more assets. Now, here's the exception, and this is the other side of the coin. I had a coaching call with a client that lived out in Iowa. For those of you guys who don't know where Iowa is, it's in the middle in the Midwest, and things are a lot cheaper out there. you can find a lot better rent to value ratios above 1%. So for them, when they got started, they bought a little house for $100,000 that could have rented for $1,000 a month. They chose to buy their primary residence right off the bat. And for that rare case, I think that makes a lot of sense because the prices of the property is a lot less. Essentially, they were buying a $150,000 starter home, or that same starter home in California or Hawaii would probably be triple or quadruple that price at $500,000 to $700,000. So this is the big stark contrast. And of course, I'm giving you more extreme examples. In the case of buying a property in Iowa or a lower price area, even Texas, it might be okay for you to do that. But if you're smart out there, you're probably seeing there's a lot of cases in between, and you're going to have to come up with your best judgment on that. Some things that have been brought up on past coaching calls, check out their YouTube section. And if you want to check out all my past coaching calls, I have it on my website for free. You can go to thewealthelevator.com/coaching. And we have all the coaching calls based on net worth. So you can figure out where your net worth is and start to watch those videos there. It's all free. We put this all on there for you guys to understand how to build wealth the right way. But in some of those calls, some people have chosen to uproot themselves and move from California over to Texas, for example, a very common path. And frankly, that's why we like to invest in places like Texas, because a lot of people are fleeing from these high price areas to these really emerging markets. And, that's on the investment side. But from a personal finance standpoint, something for you to consider. The big thing is, and you may not want to hear this, it takes a long time for you to get financially independent. Again, I bought my first property in 2009. I bought several more several years later, but I wasn't quitting my day job back then. It took me like 7 years to get to a point where I had 11 rental properties. And even at that point, I wasn't quitting my day job. You've got several rental properties, you're not super wealthy at that point, but it's a start. And I think what I've discovered over time is at some point, 7-10 years in, you start to hit an inflection point in there. It's not a get rich quick scheme, but it is a get rich surely thing over time. And I'm here to help you along the journey. If you guys have any comments, questions, put it below. My job, the reason I wrote the Wealth Elevator book was to send the elevator back down for you folks. And if there's anything I can do to help expedite that, let me know. And if you like this video, drop a like, please. And we'll see you guys on the next video. Bye.